Between 1966 and 1980, India's economic strategy relied on intense state intervention, massive public investment, and an aggressively expanding industrial footprint. The machinery of the state was running at maximum capacity. Yet, despite the massive scale of these inputs, the output remained remarkably stubborn. This chart tracks Indian real GDP growth across those 15 years. The rate swung violently from year to year, but locked onto a trend line that averaged exactly 3.5%. Factor in concurrent population growth, and the reality was even bleaker. Per capita income growth effectively flatlined, hovering between 1.0 and 1.3%. The economist Raj Krishna later coined a term for this persistent clustering, the Hindu rate of growth. The label caught on in academic and public circles, but it carried a misleading implication. It suggested a cultural or religious fatalism was responsible for the economic stagnation. We can reject that cultural explanation. This 3.5% ceiling was the measurable result of domestic policy choices colliding with severe external volatility. To understand why the economy stalled, we have to look at total factor productivity, the metric that measures how efficiently an economy combines its capital and labor. During this era, Indian productivity was stalled by three overlapping forces: severe exogenous shocks, the use of economic policy for political patronage, and a heavy-handed regulatory regime that legally constrained firms from achieving scale and efficiency. The 3.5% limit was the precise output of an economy engineered to maximize political control over productivity. The era opened in a state of severe crisis. Back-to-back monsoon failures in 1965 and 1966 triggered a 17% drop in food grain output, forcing India into a ship-to-mouth reliance on American PL 480 wheat shipments. This agricultural collapse cascaded through the macroeconomy. Facing depleted foreign exchange reserves and pressure from foreign donors, the government executed a 36.5% devaluation of the rupee in June 1966. The immediate result was the abandonment of long-term planning discipline. As this table shows, the 5.5% growth targets set by the five-year plans were never reached, forcing the state into a series of short-term annual plans just to manage the immediate volatility. Geopolitical instability quickly compounded the economic strain. The 1971 Indo-Pakistani War and the influx of 10 million refugees from East Pakistan diverted massive fiscal resources directly into defense and relief efforts at the expense of civilian capital investment. Then came the global oil shocks of 1973 and 1979. The quadrupling of international crude prices devastated India's import bill and drove domestic wholesale inflation above 25%. Policymakers found themselves confronting stagflation, a combination of decelerating growth and accelerating prices. These overlapping crises explain the violent year-over-year oscillations on the GDP chart. But exogenous shocks are temporary. They cannot explain the economy's consistent inability to break past that 3.5% ceiling during the periods of recovery. For that, we have to look at the political choices driving domestic policy. In the late 1960s, Prime Minister Indira Gandhi faced an internal power struggle against the conservative syndicate faction within her ruling Congress Party. To secure her authority, she executed a rapid leftward pivot. By rolling out highly visible populist economic interventions, she built a mass political coalition that answered directly to her, bypassing the party's traditional power brokers. This political calculus required expanding the state's reach. The existing regulatory apparatus was tightened into what became known as the License Permit Raj. The focus shifted away from the Nehru-era strategy of controlling the heavy industry heights toward the everyday bureaucratic micromanagement of private business. A prime example is the Monopolies and Restrictive Trade Practices, or MRTP, Act of 1969. It imposed strict asset size thresholds. If a private firm grew too large, it required specialized bureaucratic approval before it could expand capacity, enter new product lines, or upgrade its technology. 4 years later, the Foreign Exchange Regulation Act capped foreign equity in Indian companies at 40%. The architecture of MRTP and FERA succeeded as a tool of political consolidation, keeping private capital dependent on state favor. But economically, it was disastrous, legally mandating industrial inefficiency by punishing scale. On July 19, 1969, the government issued an ordinance to nationalize 14 major commercial banks, instantly placing 85% of banking deposits under state control. The government's stated rationale was developmental. Private banks had historically favored large urban industrial borrowers. Nationalization was presented as a correction to direct credit toward neglected agricultural and small-scale sectors. But modern political economy analysis views this move through a different lens. Economists increasingly identify the nationalization program as an expansive engine for rent-seeking. By taking direct control over bank branch licenses and enforcing priority sector lending quotas, the ruling party acquired immense discretionary power. They could distribute credit and employment as political favors to targeted constituencies on a scale the private sector could not match. Capital allocation decisions were suddenly detached from standard commercial risk criteria. Loans were issued based on political directives rather than the borrower's capacity to generate returns. By substituting commercial logic with political logic, the state centralized its authority. But it also laid the groundwork for a long-term accumulation of non-performing assets that would burden India's financial system for decades. There is one major exception to this record of stagnation. By the mid-1970s, India achieved food grain self-sufficiency, ending the chronic import dependence of the 1960s. This was the result of the Green Revolution. It relied on a technology-driven package, high-yielding variety seeds, assured irrigation infrastructure, and precise applications of chemical fertilizers. Crucially, this technological package was supported by careful institutional design. The newly established Agricultural Prices Commission guaranteed minimum support prices, ensuring farmers had a predictable financial floor to risk adopting the new input-heavy cultivation methods. Notice the contrast with the industrial sector. The Green Revolution succeeded because it utilized targeted market incentives and price floors to encourage production, avoiding the blunt instruments of bureaucratic quotas and nationalization. This success came with a significant caveat. Because the new seeds required heavy capital inputs, like tube wells and chemical fertilizers, the gains accrued heavily to farmers in regions like Punjab and Haryana, who already possessed larger, irrigated landholdings, while rain-fed cultivators were left far behind. The Green Revolution undeniably widened regional and intra-agricultural inequality. Yet, its aggregate success provides a vital lesson. Targeted institutional incentives delivered results precisely where the broader command and control economy was failing. Despite overall stagnation in GDP growth, the economy did experience a gradual structural shift. As this composition table demonstrates, between 1965 and 1980, both industry and services managed to expand their share of the net domestic product relative to agriculture. This sectoral reallocation reflects the rapid expansion of public employment associated with the nationalization program. The growth in the service and industrial counts represents the thousands of administrative roles created in nationalized banks, insurers, and coal mines, rather than a productivity-driven reallocation of private activity. To measure true economic performance, we have to return to the growth accounting equation. Output growth equals labor plus capital plus total factor productivity. Capital and labor inputs did increase during this era, driven by defense spending and that surge in public employment. But those inputs lacked efficiency. Without the ability to scale, optimize, or innovate, total factor productivity collapsed, dragging total output down with it. Retrospective economic studies find that total factor productivity growth remained effectively stagnant or negative across much of this 15-year window. This was a materially worse productivity performance than the era that preceded it. The economy was absorbing capital without generating corresponding productivity. The state diverted funds towards subsidies and defense, while the license permit Raj legally restricted private firms from upgrading their technology or reaching efficient economies of scale. The 1966 to 1980 era is the moment India's structural ceiling became impossible to ignore. By prioritizing populist patronage and political control over allocative efficiency, the state constructed a fiscal and regulatory trap. It was a model guaranteed to stall, and it directly necessitated the market-oriented reforms that would finally emerge in the following decade.